Okay, guys, inflation numbers just came out. If you were watching pre-market, stocks went from up 1% pre-market to at one point it was down over 3% pre-market. So what happened? CPI came out. Inflation numbers came out. Analysts were expecting 8.1%, came out at 8.2. There were some positives in it. Energy is down 2.1%, which is, as you've probably seen at the gas station, if you look at gas prices over the last few months, it's a lot lower now than it was before. But food prices and, if you look right here, medical care were higher. Food index jumped 0.8% last month. Now, why is this concerning everybody? You know, it's funny. If you go back to our videos 2 years ago, last year, you look at negative news, and negative news was met with enthusiasm. Why? Because it meant the Fed was going to lower rates more. Well, now things have changed. Inflation is really, really high. And I want everybody to remember, GDP has fallen on a real basis. That means after inflation. But if you look at nominal GDP, that means GDP taking out inflation, we're up like 5% in the last year. Why? Because inflation is going to come down from it in terms of real GDP numbers. So that real GDP, the real part of it, means based on after inflation dollars. So GDP is still rising. Good, bad, indifferent, whatever, it's still rising. We still have inflation. It is still worse now than it was before. Jobs data in September was bad. Only 263,000 jobs added. Now, the interesting part is unemployment rate went down. Why? Probably a lot of people exited. People stopped looking for jobs, or they just didn't care to find jobs, or whatever it is. Things are softening. Now, I do believe the Fed, behind closed doors, is doing this on inflation. They want to raise rates. This morning also, I believe every single Treasury yield between 6 months and 20 years went above 4%. We haven't had 4% in a long time. Let me show you guys the 10-year Treasury and where it's at. Market's actually rebounded a little bit. Look at that. So let's look at the 10-year U.S. Treasury. And let's go 3 years. Look at the last time. I mean, this is 3 years. We hadn't been above 2% until recently, until earlier this year. And the historical average for the 10-year Treasury is about 4.4, 4.5%. So we're starting to get closer to that historical average. But the Fed has said they want to raise rates. The current Fed discount rate is 3 to 3.25%. They want to raise it again. Who knows if they use this as an excuse to go even further? I have no idea. This morning, the 10-year Treasury, I texted some friends, was over 4%. Now it's retreated a little bit. So what does this mean for you as an investor? Guys, don't worry about this stuff. Markets are overvalued. The 3 best metrics for long-term returns show that the market's overvalued. It should be, based on historical returns today, based on today's numbers, the S&P should be in the low 2,000 range, 2,000 to 2,200. Now remember, stocks definitely don't go to their value. They go above and below. But we also have high inflation, which is pushing up nominal GDP. So in the stock market to GDP ratio, that lower number is getting higher and higher and higher. If the stock market just can't stay the same and that nominal GDP keeps going up, what happens to that ratio? It decreases, which is what we want it to do. We want to go back to historical levels. We will probably go to lower levels. Let me show you guys a stock market GDP that I created just last night. This is my stock market GDP, just doing the S&P 500 going back to 1929. The average, 0.881. Now remember, this isn't like the other stock market GDP that I've talked about before. This is just mine based on the S&P. It's not the total market index. It's just the S&P. That's why some of these numbers are going to be different. However, the point is it goes back to 1929. And that's the point of it all, looking at some sort of consistent factor. The max was 2 back in, I think, 1929 or so. But look at this, guys. 1.923. That was 118% over value back in September of 2021. And look at GDP. June of 2021, we were at 22.74 billion. This one I just put in place. In June of this year, we were at 24.8. So $2 trillion increase even with high inflation. That's the point what I'm trying to say to people. Inflation is the real GDP number. Now, here's the interesting part. Our current ratio, if GDP is the same, is 1.438. Let me take you guys back in time to what many consider to be the worst stock market of history. March 31st of 2000. The ratio, 1.461. We're basically at the ratio we were back in the start of the crash. March 10th of 2000 was the start of the stock market crash to the dot-com bubble. So we're at that level now. So even though the S&P is down 25% year to date, the NASDAQ is down over 35%, we're just at the levels now based on valuation of where the NASDAQ and S&P started their crash back in 2000. That's just shocking to me. And with inflation here, you're looking at it going, okay, inflation is not transitory. How long is it going to be around? Well, I do think the Fed is going to be very aggressive about increasing rates a lot sooner than they did back in the 70s. However, that is going to probably lead to recession. It's amazing. A year and a half ago, nobody even thought, oh, there's no way. There's no way we're going to have a recession. Now it's literally like 86% of CEOs or some crazy number, or 86% of people out there think that we're going to have a recession or we're in one. Guys, I want you to remember this. The pendulum swings side to side, extreme to extreme. My goal as an investor is to sit here and look at the world and say, is it crazy? And if it is it crazy high or is it crazy low? That's all I'm trying to do. And in the last year, 2 years, 3 years, 4 years, I'm like, man, this is getting crazy. And for those of you who thought I was nuts for thinking the market was overpriced, look at this. Back in 2016, we were at 1.126, 1.183. We were 30, 40 growing even back when Trump took office, right here, we were 40% overvalued. We were at levels that were not seen except for the extreme markets of history. To see how low it can get, look at 1982. That was the bottom of the bear market. 1982, this ratio got to 0.329. We're currently at 1.4. That would involve our stock market today falling about 75%. To get to those same levels. Now, that doesn't mean that's going to happen. Please don't take it as that. That's not what I'm saying. What is going to happen in the next 4, 5, 10 years, GDP is going to go up, stocks are going to go down, and at some point we'll get to a much more reasonable level. So just to tell you, just to show you, if the S&P was 2,200 right now, we'd basically be at fair value. Okay. Now, again, it will take time for that to happen. In that time, nominal GDP will go up. So just like I said before, over the last 4 or 5 years, as nominal GDP goes up, that ratio goes lower and lower and lower. Now, if it's met with ever so increasing prices, it's a problem. The great news we have right now is, I think that we have the Fed increasing rates and bringing things back to normal, bringing stocks at better prices. So your goal is to buy good investments at good prices. It's especially important that you learn how to analyze companies for value and have what's most important, margin of safety in everything you do. Whenever there's a lot of volatility, margin of safety is very important. So you need to watch this next video where I discuss how to buy value stocks and use margin of safety to be a successful investor.